is Régis Maraudon. I'm with the organizers and also one of the animators of the Global Research Network Group. Thank you very much for attending this breakout session. And I will turn the floor to Valerie Laxton now for the animation of this research presentation on maximizing the impact of PDB in financing the transition. What a challenge, no? Valerie, it's for you.
Thank you, Régis, and welcome everyone to this session. Good afternoon. This session is entitled Maximizing the Impact of Public Development Banks in Financing the Transition. So we have a big agenda ahead of us. We have the privilege of being here in Cape Town, and thanks to all of you who are joining us online or will watch this session online. This session has been prepared by our working group on sustainable investments under the Global Research Network of the Financing Commons Summit. My name is Valerie Laxton. I'm a senior associate at WRI, the World Resources Institute, in the Climate Economics and Finance program. I lead our work on development banks, international financial institutions, and the global financial system. And we're hosting this session together with the Institute for Climate Economics, or I4CE, and my colleagues who coordinated this work stream with me are Sarah Bandaou and Blandine Arvis, who are both research fellows for development finance at I4CE. I4CE also runs the secretariat of the Mainstreaming Climate and Financial Institutions Initiative. Public development banks have a unique role to play in supporting the implementation of national long-term transition commitments as they're entities that have been invested by the parties to the Paris Agreement. How so? Well, they can channel much needed public funding towards activities that make the biggest contribution to national low emissions climate resilience and just development pathways in the spirit of sustainability and solidarity, as Mr. Bergloff reminded us this morning. So although the central role of public development banks in driving the sustainability agenda is acknowledged by most governments and public development banks themselves, there are a number of challenges that remain in translating this potential into concrete outcomes and into transformational action. We have a lot of noise in this room. I don't know if it's disturbing, but let's carry on. And there are two well-known shortcomings or barriers to sustainable investments. One is to identify clear investment opportunities in some markets, sectors, specific sectors, and secondly, the absence of sufficiently developed impact indicators, which we always hear from. And we will explore these challenges further in this session. Ultimately, this session should help us to understand how the impact of public development banks on low emissions and resilient development is currently being assessed, and how appropriate data is crucial in this regard. So that's number one. And then in the second part, we'll be looking ahead, and we will identify some opportunities for public development banks to maximize this impact and increasingly contribute to a deep transformation of the real economy. And to address these important questions and challenges, we have a fantastic lineup of speakers and panelists today. In the first part of this session, we'll hear from Mrs. Isabelle Bébéard, Head of International and European Affairs at BPI France, the Banque Publique d'Investissement, public sector investment bank. From Mrs. Barbara Marquito, Head of Current Country and Financial Sector at the European Investment Bank. From Mr. Romy Calderon Alcas, Director for the Program for Economic Studies at ALIDE, the Latin American Association for Development Financing Institutions. And Mrs. Aurora Akanchka, Senior Director of Strategic Affairs, Multilateral Development Banks, International Sustainability Standards Board, IFRS, the International Financial Reporting Standards Foundation. And in the second part of this session, on the more forward-looking part of the solutions we're seeking to to address. You'll hear from Mr. Jonas David, Research Director at Anthropocene Fixed Income Institute, Mrs. Nicole Pinko, Manager at CPI, the Climate Policy Initiative, Mr. Shaji, Chairman of the National Bank for Agriculture and Rural Development, NABARD, in India, and Mr. Jennifer Zungu of SANBI, the South African National Biodiversity Institute. Thank you all for being here today. So, without further ado, in the first part of this session, we'll hear about case studies to explore the different solutions offered by public development banks, in the first case to support the decarbonization of SMEs, small and medium-sized enterprises, and in the second case to support the climate solutions specifically. So how is impact being assessed, and how is data crucial in delivering on our sustainability goals? We'll have two pieces of research presented, and I turn to Isabelle Bébéard in the first place from BPI France, who will present research by the Montréal Group, a group of public development banks that focuses on micro, small and medium-sized enterprises, and you'll probably tell us more about what the Montreal Group does. They've been working together as a group to unlock the decarbonization of SMEs, so as to make sure or assess how PDBs are measuring the success of their solutions. Isabelle, I think your PowerPoint is up, yes. So the floor is yours. Over to you.
Thank you very much. And thank you for the invitation. So just in a few words, Montreal Group, it's an international forum created to foster exchanges between national public development banks, and it has been created 12 years ago. We have 12 members representing five continents. First of all, rapidly, the objective and the methodology of a study. So it's a study that have been done with our chief economists. We had two objectives in this research. First of all, look into the green solution offered by the public development bank, and second, how they measure the impact of the solutions they provide. So the methodology was conducted in two parts. First of all, sending a questionnaire completed by 16 development banks, and then 60 minutes complementary interviews with 12 public development banks, and of course different documentation shared. What we've observed is the main goal of green solution. We have three categories of solutions. First one, those who help develop technologies contributing to a low carbon economy, such as clean energy manufacturing or non-emitting and renewable energy. Second one, those who enable businesses to directly reduce their greenhouse gas emissions. And third, those who help businesses adapt to current and potential climate change risks. And with this last category, of course, the importance have grown due to the growing number of extreme weather events around the world, unfortunately. Then we have found 4 types of products that public development banks are offering to their SMEs. The first one is direct loans. It's the most popular. And the objective is to help SMEs in investing in green machinery, processes or buildings, and support investment in green electricity generation. And it's often accompanied with a business support advisory service and offered at a lower rate, or with a guarantee, without a guarantee. The second type is indirect loans and guarantee. The advantage of those indirect loans and guarantees that helps reach more businesses. It's often complementary to a direct program. It enables also PDB to reach smaller and more rural businesses, and it encourages private sector also to co-finance, and also You can find it with advisory services. The third one is non-financial support, and this can be in the form of advisory services or training service. The objective is to allow SMEs to understand the best way to increase their, to measure, their carbon footprint and monitor their process. And then the last one is equity, often used to support startups developing green technologies. And equity is done direct investment or indirect solutions with fund of funds. So now the challenges we found and how programs are evaluated. Alors, three challenges in implementing a green solution are faced by Public Development Bank. The first one are problems identifying, it's difficult to identify eligible projects, so it means if a project can be qualified as green or not. The second difficulty is simplifying the procedure for SMEs, because to give a loan or to invest, you ask too numerous questions to the SMEs to confirm the eligibility, and sometimes it's too big for the companies. And of course, the last point is the scarcity of available funds. And in a lot of countries, this kind of program have a lot of success, and Public Development Bank no longer have money to respond to the demand. Second part now, how Public Development Bank sets their impact assessment procedure. What can be their key metrics? Alors, you have financial indicators. That's quite easy. The number of loans issued, the number of businesses supported, total fund disbursed. You have also key metrics on economic and social, GDP growth, revenue growth of supported SMEs, etc. 1 and 2 are relatively standardized. I think the more popular but the more difficult to assess is the environmental impact, GHG emissions avoid, energy generated from renewable sources, etc. So as you see, it's a combination of metrics, and generally it's a mix of financial and environmental metrics. The most popular, but the most difficult to measure, is the GHG emissions avoided. Last, we've done a focus on measuring GHG emissions. The concept is easily understandable, but yet difficult to implement. Why? Because you have several challenges. First of all, the lack of reliable data. Secondly, the challenge to scale the methodology, because each project is unique and has a different impact on emission avoidance. And the third one is collecting data needed to perform the assessment, because it's a burden on SMEs, and sometimes it's discouraging for them from using the solution. The good news is that Public Development Bank have begun identifying some solutions. Alors, database clinical analysis is the information on the exact technology purchase is collected on each project and is compared in the database. The second one is diagnostic, audits before and after investments. And the last one is a survey, so surveyors as clients before and or after investment. So as a conclusion of this study, 1, green solutions are recent, and Public Development Banks are only at the beginning of it. 2, green support has been widely developed in the last few years, and more green solutions will be implemented in the years to come. 3, finally, today's challenges remain, creating a business-friendly program while being able to evaluate it. And fourth, all public development banks are going toward the same direction when it comes to helping SMEs achieve their green transition. Thank you.
Thank you very much, Isabelle, for underscoring the main challenges and the lack of data, how to scale the methodology, but also, the difficulties in finding the appropriate data, basically, for these purposes. That was very insightful. I'd like to turn to you, Barbara. Barbara Marquito is going to present a study that you did at the European Investment Bank. I understand it's joint research with ALIDE on climate finance in Latin America and the Caribbean. How are PDBs supporting the climate transition? And with that, I leave it over to you.
Thank you very much. Good afternoon. I'm really happy to have this opportunity to share the results of this study, which was actually conceived within the global research network, discussing with peer institutions. And the analysis is centered around a survey that we carried out thanks to ALIDE. For those of you who are in the business of collecting microdata, firm level, bank level data, you know how difficult it is to get responses. So we're really grateful to ALIDE for giving us this opportunity. And in fact, what we would like to do is to show what we have learned from the PDBs about the role that they have, how they see themselves as actors in the climate transition and the challenges that they see ahead of themselves. Next slide, please. So just to set the scene, climate risks in Latin America. At the EIB, we have developed some climate risk scores for the countries where we are engaged, over 180 countries. And as you can see from the chart on the left-hand side, Caribbean countries, alongside with Middle East, Sub-Saharan Africa, and the Pacific, are amongst the most hit regions, 2.5, 3 times more than the world average. And the red bar shows acute risks, so the losses and damages stemming from acute events, storms, fires, droughts, etc., which in the Caribbean are particularly important. This is also common to other small island states. And despite the very relatively low contribution to GDP emissions, we know that some of the countries that are most affected are the ones that are least contributing to CO2 emission. So next slide, please. Against the backdrop of mounting risks, we know that the challenges and the investment needs are huge. Here we are just reporting some estimates from the European Commission for Latin America and the Caribbean, and they estimate that the cost of inaction in terms of facing climate change could be between 1 and 6% in terms of decline in GDP per capita between now and 2030. And in terms of investment needs, their estimate, there's a bit of a variation, but the numbers are big, whichever way you look at them. Climate change commitment will require investment, according to the EC-LAC, between 3.7 and 4.9% of the regional GDP every year. This is 290 million on an annual basis. IMF has somewhat lower numbers, but still we are in the range of 2% a year in terms of regional GDP. So huge needs. The scale of the challenge is enormous for the public sector alone to face it, and that's why we will be talking about catalyzing private sector involvement, not to mention the fact that the region is facing a challenging macroeconomic environment. There's a lot of uncertainty and fragmentation globally, so I think it's momentous, the challenge that we have ahead of us. Next slide, please. So our survey we carried out to understand, like I was mentioning earlier, what is PDB's engagement in climate finance and what are the challenges that they are facing. The survey was carried out at the beginning of last year. It included 28 public development banks in 15 countries across Latin America and the Caribbean, and the banks that we surveyed represent about 50% of the assets of PDBs in the region. So the first question we asked them, if you could move to the next slide, is how exposed they feel to climate risks. And in line with the significant exposure of the region, they told us that they are feeling the burn. 40% of the PDBs, as you can see in the chart, reported that extreme weather events damaged their physical infrastructure, branches, headquarters, etc., at least to some extent. And nearly 60% of the responding banks in our survey also reported that acute events contributed to a deterioration in the quality of their portfolio. And among those impacted, 46% identified the segment of small and medium-sized enterprises and micro-enterprises as the most affected categories of borrowers. Next slide, please. We also investigated their strategic approach to climate transition and the role that they see themselves playing in it. An overwhelming majority, more than 90% of the banks we surveyed, they see climate transition as an opportunity more than a risk, which is encouraging, of course, but they do not see themselves as trend setters. In fact, 7% of the PDBs in our samples identify themselves as skeptical. They said that for them, climate change is not a risk. There is not even a need for a transition, and they're not implementing any measures unless there are some minimum regulatory requirement. Then we have 14% of the PDBs that identify themselves in the followers categories. They are following trends in the field, but they do so more to keep up with competition rather than as a result of a deliberate choice or deliberate risk assessment. Encouragingly, we have you just stay on exactly. We have 29% of the banks in the samples that see themselves as promoters. They're trying to address the challenges of climate change, at least to some extent, and 18% identifying as leaders. These are the PDBs that say that they have climate risk fully embedded in their frameworks and in their strategies, with strategies approved by their board, etc. Now we can move to next slide. What is interesting to see in this slide, maybe it's more the chart on the right-hand side, is that there seems to be a clear relationship between the type of PDB and their approach to green lending. So the banks that identify as skepticals, they do not have any green products. They do not offer any green loans to their clients. On the other hand, the leaders, it's the gray bar, have 20% of their portfolio accounting for green loans. And if we look at the flows, which are the bar charts on the left-hand side, there is a positive trend. So in terms of the new loans granted in 2023, there is quite a bit that are in the green realm, and the majority of the green portfolio is allocated to micro and small and medium-sized enterprises. So this seems to be where the needs are, or where demand meets supply. Moving to the challenges, in the next slide, we obviously asked them, what is it that is holding you back from lending more, scaling more your green activities? And PDBs tend to identify lack of skills on the side of their clients, low priority that the clients attach to climate transition, and an awareness of green finance. On the other hand, when they look at their own bottlenecks and challenges. Again, capacity is an issue, tools and standardized metrics, and also for 20% of them, the lack of or limited access to long-term capital. What you don't see in this slide, although it's a result that I really like, is that there is the skeptical or less engaged PDBs are the ones that claim to be suffering more from capacity constraints. So this points to a potential interesting intuition, meaning that if we can raise awareness and increase capacity, we can enhance the understanding of what climate transition is, what it entails, and therefore of the role that PDBs can play. And this leads me to the conclusion. PDBs, particularly in Latin America, are already doing a lot. They account for nearly 50% of the credit in the region. This is much more salient than in other parts of the world. When it comes to climate lending, raising awareness, building capacity, creating an enabling environment with the green taxonomy, etc., is crucial for PDBs also to catalyze and invite private investors. And last word on what we, IFIs, MDB, can do is not only providing patient capital, but also contributing to this capacity building that I was referring to. Thank you very much.
Thank you very much, Barbara, for this, for enlightening us with this survey and this very good overview of what you saw and the lessons learned, especially about collecting microdata, the role of PDBs as actors in the transition, and seeing the climate transition as an opportunity as well. But I'd like to ponder a little bit on what others can do, and your last point in particular, the capacity constraints, and maybe hear from Alide, from Romy, from the Association of Latin American DFIs. Help us understand, Romy, how complementary sources of finance and perhaps international finance can work better to address the capacity needs of public development banks on the ground, if that is something you'd like to share with us.
Excuse me. When I received the invitation by Yakuton and Reyes, I said then, my English is not good, but they said me, if the development banks can do many things, you can do it also. For this reason, I am here. Some ideas. It's clear that financing to projects, climate projects, is a little. They have large gaps. This is the first conclusions in the study. Other aspect we call meets, called attention meets, is why the development banks don't sit like a leaders. It's strange for me, because they are focused in this project. This obviously touches me proud, no? In my opinion, the development banks wants to do more things. They wants to support with finance more projects in your countries, but they have different barriers and limitations. The first is regulation and supervisions. In general, in our countries, the regulations consider the development bank similar to commercial bank. Not consider the kind of projects this entity financing. Other aspect is by law of creations, the development banks has a mandate. They can doing more things that say your lot of creations. This is a limitations. This is not permitted flexible actions to act. Other aspect is that the last long-term financing in adequate conditions. I refer when the development banks gets funding from the capital markets or international institutions, they receive the financing in foreign currency. When you receive these resources, have three possibilities. The banks keep the risk, transfer the risk to clients, or they if have the possibility to get coverage to protect this kind of risk. In the third possibilities has a great problems. The financing to the clients is higher, is expensive. In these solutions not permits financing some projects that very important to developments for our countries. But there is many opportunities. Climate finance is crossing all sectors. In Latin America, all sector has an opportunity to financing projects relation with climate finance. But we have these problems. According to the other surveys, the study considered one survey. This is other survey from 22-23. When the development bank said the main challenges are, Isabel says something similar. Support to SMEs is a challenges, the main challenges by 69% of the banks. And promotion, financing and inclusion, 46%. Boosting green and sustainable economy, 58%. And financing infrastructure, 42%. This is the main principle, but there is another. For example, for other sides is the funding is very important challenges by development bank. I have other. Is enough? Thank you.
Thank you. That was perfect for me. Thanks for underscoring these major constraints and notably reiterating a point that keeps being made but needs to be heard loud and clear. That the currency received is in foreign exchange, and that is a key barrier, but also that it limits the capacity of PDBs to extend public climate finance also. Now I'd like to turn to Aurora from the IFRS Foundation. Tell us a bit more about other challenges that PDBs face, public development banks face, in making sustainable investment decisions, and how the ISSB standards help in this endeavor.
Thank you. So the biggest challenge that PDBs face in making sustainable investments is access to high-quality, decision-useful data from their investees so they can make informed decisions. And the reason this problem exists for PDBs as investors and PDBs as investees is because there's no standardized framework on reporting sustainability risks and opportunities. I'm sure you've heard of the different alphabet soups that companies follow, the different standards and frameworks. So IFRS Foundation solved the alphabet soup in accounting standards 20 years ago when they created IFRS accounting standards. So fast forward, in 2021, we were mandated by Financial Stability Board, the G7, and IOSCO, the International Organization of Securities Commission, to create a global baseline of standards that companies could use to report on their sustainability risks and opportunities for investors to make informed decisions. So that is who we are, International Sustainability Standards Board. We offer that global baseline for PDBs, IFIs, and any investor to make decisions. What have we done so far since 2021 is we have released two standards, S1 and S2. S2 is sustainability on climate, S1 is general. What is the status so far? 35 jurisdictions all over the world have adopted this standard as a mandatory reporting guideline. This includes Canada, UK, Japan, Singapore, Brazil, Switzerland, Sri Lanka, Malaysia, many others, which I'd be happy to share with anyone who would like to have a bilateral with me. These jurisdictions represent 40% of GDP, 50% of GHG emissions. And what we're noticing is not just the countries making this decision, but investors like BlackRock, Vanguard, Norges have included ISSB in their proxy voting guidelines. So this is the solution, we think, of having a standardized framework to report against that can help PDBs in making investment decisions, doing co-financing, joint financing on projects, and also reduce their cost of capital. Something we heard during the plenary today is the cost of capital is too high, is because everyone who needs investment at a project level has to produce 1,000 reports for everyone, and that is very cumbersome and inefficient. So with that, I will conclude my section and pass it back to you.
Thank you so much, Aurora. And I'd like to underscore this need for access to high quality data for helping the decision makers on both sides, be it investees or investors' side, for PDBs to actually carry out their missions. And also that the point you made rightly, that the cost of capital increases, and that needs to be limited. So if reporting is standardized, it definitely represents an opportunity to limit that cost of capital. Wonderful. So thank you for these two presentations, Barbara and Isabel. I'm going to, in the sake of time, switch over to the second part of this session, where we will delve into the path forward. What are the new avenues which are being tested and could transform the financial landscape for investing more systematically in a way that drives outcomes linked to climate and nature? So here we'll try to grapple with the question of where are these opportunities for more impact, maximizing impact of PDBs, and increasingly contribute to a deep transformation of the economy, one that also delivers for climate and nature. And to help us look beyond what's already been proposed, I'll now invite Jonas David, a research director at Anthropocene, to introduce sustainability-linked instruments and bond structures with credit enhancements, and what these can actually do for the cost of capital for national or regional development banks. Over to you, Jonas.
Thank you, Valerie, and yeah, great to be here. Thanks for having me. So, as a brief introduction, the Anthropocene Fixed Income Institute is a non-profit research organization that takes a markets-based approach to delivering positive climate and nature impact. And we enable market participants to direct capital to impactful sustainable investments. And if you would like to learn more about us and follow our work, please scan the QR code over there. So this research project would not have been possible without the support from various stakeholders and partners, in particular AFD, the French Development Agency, and I recognize quite a few people here in the audience and would like to say thank you. In our paper, we explore new approaches of financing for public development banks with a goal to reduce the cost of capital and crowd in investors, and both would help to achieve the sustainable development goals. Significant investments are needed, particularly in emerging markets and developing economies. And while there are long discussions about the specific amount of investment required and bankable projects available, I think there seems to be consensus that more must be done based on the various conversations that we already had today. PDBs can play a key role in scaling up sustainable finance and driving transformative investments, but they need access to affordable long-term capital. And a key question for us was how this can be done in practice. So building on our experience in fixed income markets, we reviewed the role of labeled debt, like for instance green bonds, and PDBs are sizable issuers of these bonds and have played a key role in growing the asset class to over 1 trillion in annual issuance. But this is mainly driven by larger institutions with investment grade ratings. And then we assess the suitability of performance-linked debt structures, more specifically sustainability-linked bonds, like also called SLBs, as a source of funding for regional and national development banks. And combining such bonds with credit enhancements like guarantees has the potential to unlock private and public capital. As a very brief introduction to SLBs, these are bonds where the coupon adjusts depending on the achievement of sustainability objectives. Typically, the coupon would step down if targets are not met, step up if targets are not met, and there are technical reasons why this kind of structure is dominant. But there are ways to address this to align incentives for positive impact using step downs. Importantly, SLBs take a holistic perspective of the issuer instead of focusing on specific assets, and therefore offer greater flexibility. So often they are particularly relevant for lower rated and smaller issuers that might not yet have a sizable pool of green projects that they want to finance. As a proposal for a new bond structure, we outline contingent resilience-linked bonds with a partial credit enhancement that is activated if performance targets are reached. And this novel concept addresses fundamental issues and has the potential to mobilize capital via development banks. Simplified, this so-called Coral bond is a standard SLB with step down, but where a third party, for instance an MDB or DFI, provides credit enhancement contingent on the achievement of sustainability or resilience targets by the issuer. So in practice, the MDB or DFI commits capital to achieve a higher recovery rate in the case of a potential default of the issuer. A regional or national development bank would issue this bond and commit to performance targets, for instance related to renewable energy, and if they don't achieve them, it will just work as a plain vanilla bond. However, if the issuer achieves the target, there will be a meaningful coupon step down and a partial guarantee kicks in to mitigate default risk. Through a decomposition of the pricing components, we derive key parameters so that investors should be willing to accept the lower coupon in return for the guarantee. And importantly, the DFI, MDB or philanthropic donor that provides the guarantee already knows that the sustainability target has been achieved when the guarantee is activated. We show that these bonds can be structured to offer sizable and incentivizing step downs. At the same time, they only need a relatively modest credit enhancement and create a balanced incentive structure for all stakeholders. The investor gets an investment that is at least as good as a traditional bond with the added sustainability benefits and potential upside from credit improvements. The issuer gets incentivizing financing with potentially lower cost of capital for sustainability and resilience projects. And finally, the provider of the credit enhancement has a relatively low and well-defined contingent exposure. We also look at specific examples, how the structure could look like in practice, using market data for development banks, and we were able to apply this structure both in a foreign and local currency context. To conclude, our work addresses the need to mobilize more capital for sustainable development in an effective way, with PDBs as important players, and we encourage development banks, investors and stakeholders to look into specific market-based approaches like Coral to complement existing funding sources and facilitate more SDG investments. As a call for action for national and regional development banks, if you explore ways to access capital markets and diversify funding sources, let's discuss how a Coral structure could look like in your case. For MDBs and DFIs, your role is critical as enablers of innovative solutions. This is one. And finally, we have started to discuss this concept with investors and are keen to involve more. So yeah, thank you very much, and please feel free to contact me if you're interested in further details. Thank you.
Thank you very much, Jonas, and thanks for underscoring these instruments that are already frequently used by public development banks like green bonds, and but also the fact that PDBs can come in different shapes and forms and different sizes, and speaking to the diversity of the ecosystem is also very important. Thank you for that. Now I'd like to turn to Nicole Pinko, who's a manager at CPI, and who will share her reflections on leveraging public development banks in scaling debt for nature or debt for climate swaps, and the potential these instruments hold for public development banks. Over to you, Nicole.
Thank you, Valerie, and good afternoon, everyone. So I'm going to speak a little bit today about debt for climate or debt for nature swaps and the options available for public development bank involvement. Next slide, please. Get closer. Apologies. There we go. So really the last couple of years have, obviously everyone in the room knows this, but shown the ways that climate and debt issues are really closely interlinked. You've got climate change impacts that diminish economic output and consume fiscal resources for disaster relief and reconstruction, and that contributes to unsustainable debt burdens. And then those heavy debt burdens limit fiscal space for climate action, especially around areas like resilience and adaptation. So debt for nature swaps are really an attempt to address both those issues simultaneously, and they've gotten a lot of attention in the last several years. A recent Ecuador proposal has really added into that interest as well, or not proposal, apologies, swap that went through has really added into that interest. And fundamentally at their core, debt for nature, debt for climate swaps involve the cancellation, exchange, or refinancing of a portion of a country's public debt in return for policy commitments to reinvest that resultant debt service savings in environmental conservation or climate projects. So essentially providing a haircut to the country's debt and then moving that same financing into a more conservation-focused area. Next slide, please. So there are two early on types of swaps that are available. The bilateral non-commercial swap mechanism is a little bit more the way that this was originally envisioned, and a little bit more simple. You have a creditor, you have a debtor country, and then essentially all those avoided debt payments are transferred to an escrow account or a fund that then is moved to an agreed upon nature or climate project and to finance in that manner. Again, you'll see that proceeds are really kind of driving towards that nature and climate aspect. Next slide, please. A more common transaction mechanism that's used currently is a commercial swap mechanism or a trilateral swap mechanism. And this involves a lot more actors, particularly you have ESG investors and donors, you have an NGO that's being quite involved, and it really involves more commercial creditors than, say, a DFI or an MDB as the creditor in this case. You also use a special purpose vehicle for that debt swap transaction. But again, at the end of the day, that funding is being dispersed for the agreed upon climate or conservation projects. So one thing that I do want to highlight from both of these instances is that when it comes to the creditors, you often will see either commercial creditors or occasionally an MDB or a bilateral DFI. But the ways in which public development banks and EMDEs are concerned on that debtor side, they're really left out of the conversation. You have the debtor government involved within the emerging market and developing economy, but national development banks or subnational development banks really are not traditionally involved in these conversations. Next slide, please. So one of the things that we've done some research with our own interviews and our own research as part of the FIX Financial Innovation Lab and our Debt for Nature Swap Working Group is really trying to figure out where public development banks fit in and what where they fit into these factors for a successful swap. So we found 4 key factors that have the most influence. The first is around fiscal conditions. We need to, have a position where there's limited fiscal space, and that is the main barrier to climate investments. We also want to see additionality in that the swap needs to support new climate investments beyond existing climate plans. There should be a lot of coordination in aligning swaps with the national climate and development priorities. And lastly, the debtor needs to have a certain amount of capacity and able to have strong debt management, project implementation, and negotiation, as well as monitoring capabilities. And we've really found that when thinking about public development banks in emerging markets, their potential to support these activities is really around those last 2, that coordination and that debt capacity. Next slide, please. So in all of our interviews and within our working group, we found that there are about 7 ways in which public development banks can really support a debt for nature or debt for climate swap. The first 4 of these are really around financing opportunities. And these are not quite all public development banks and EMDEs, but we're trying to think about the broader range of public development banks and public financial institutions and how they can be involved and supportive in this process. So that first opportunity is around MDBs and DFIs that have an international mandate, and they can actually increase the attractiveness of a swap by providing credit enhancements such as guarantees and political risk insurance. John has already talked a little bit about the ways in which credit enhancements play a huge role here to make investments more attractive. And these mechanisms themselves are more challenging for national development banks to provide, as their credit rating is typically tied to that of their country's sovereign debt rating. We've actually seen this work very, very well in recent swaps in Belize and Ecuador. The second area is around insurance, in that the MDBs typically only provide about 70% of the credit enhancement through guarantees, and they often need additional involvement of multiple MDBs to actually reach 100% of the full requirement. So while this is untested, there is a potential for more regional MDBs or public development banks like the African Development Bank or the Asian Development Bank, or even sort of BOAD or more regional focused areas to address this gap by covering the remaining credit enhancement needs, that kind of tail end credit enhancement necessary to reach 100%, particularly on sovereign risk and catastrophic risk. The third idea is really around ways in which DFIs and export credit agencies can, with claims abroad, so areas where there's already a bit of a existing debt claim, can use those to negotiate swaps that provide partial debt relief in exchange for funding environmental or climate projects. So trying to use leverage existing debt that exists elsewhere. And then lastly, there's a possibility for local solutions where national public development banks that hold subnational debt can actually do a local currency swap that facilitates debt relief within that subnational entity. Again, untested, but kind of an area that's worth exploring a little bit. Next slide, please. There are 3 other opportunities we've found that are a little bit easier to do. They're outside of that financial area, but they do still offer a lot of support to the debt for nature swap or the debt for climate swap. The first is that public development banks can really amplify the impact of the swap. They can provide additional concessional financing for the projects to really build out what it looks like in terms of the impact and the size that the project is able to take on. The second is around the delivery and monitoring of climate KPIs. I think we heard earlier about sort of the lack of data in a lot of these cases and the need to really prove additionality of some of these projects. It's gotten a lot of attention, what the additionality of the existing debt for nature swaps is. And public development banks have been thinking about this a lot, especially if they have their own climate funds or green bank aspects. And being able to support the delivery and monitoring of those KPIs can really demonstrate the public development bank or national development bank additionality. And the last is really about supporting capacity building for a national government's ability to negotiate and implement a debt for climate deal. And this is really by providing their own financial expertise. National development banks have a huge amount of financial knowledge and know-how and are very familiar with some of the negotiation tactics that are used within these kind of large-scale fundamental instruments. So there's an option for them to support government efforts by participating there and helping coordinate. And lastly, just as I mentioned, I've mentioned the FIX Lab and our Debt for Nature Working Swap. before. We actually are not planning to have the Debt for Nature group anymore. We're shifting to other ideas. But we do have a paper that outlines all of this in a little bit more detail with more distinct ways to get involved that is up on the CPI website as well as the Fix Lab website. So happy to answer any questions you have there. Thanks. Back to you, Valerie.
Thanks a lot, Nicole, and thanks for highlighting the conditions for all these instruments to work and to address the needs that we are seeing that are pretty large for public development banks. And in reducing the cost of capital and swapping debt for nature and climate outcomes, you've just heard very insightful contributions on how to go about implementing such instruments in the case of public development banks. And we would like now to invite Mr. Shaji, who is chairman of NABARD, the National Bank for Agriculture and Rural Development in India, to share perspectives and experience with us about the implementation of such instruments. So our speakers have presented two very different types of instruments: sustainability-linked bonds, debt for nature swaps. How easy is it for you as a development bank in India to implement these? What are the considerations and challenges you're facing in practice when weighing how to finance desired investments that pursue your own priorities? And as a follow-up, which types of instruments are most enabling to effectively mobilize for pursuing your own objectives in your current context?
So thank you for the opportunity. So I am from National Bank for Agriculture and Rural Development from India. India, as you know, is a massive country with a population the highest in the world, where around 60% are in rural areas. Still, a lot of urbanization need to be there, and almost 75% of India is yet to be built. That means a lot of actions need to be there. For that, a lot of funds are required. Of course, the Indian government, because of its progressiveness of late, has been sourcing those funds internally in terms of, the growth in India is one of the fastest in the world. But then, we being in the rural areas, dealing with agriculture, almost 60% of the total population of India is affected by whatever we are doing. So in our venture to support the initiatives in agriculture sector and the rural sector in India, we actually source various types of funding. One, of course, is the concessional funding from the government, because we in India have a peculiar system of targeted lending by the commercial banks. So commercial banks are mandated to lend at least 40% of their total credit to those areas which actually left to themselves they will not lend, like agriculture, medium and small enterprises, maybe emerging sectors and such other things. And if any of the commercial bank fails to achieve that 40%, the differential of that target should be kept with the Central Bank of India, that is the Reserve Bank. And from there, they will, at the concessional rates, Reserve Bank will give these banks at around 4%. If you see the market rate in India, it's around 6.5, so almost 2.5 concessionality is there. So from this source of fund, Reserve Bank of India gives us this limited kitty, but then this we will direct towards subnational entities. We are telling about subnational entities to be given concessional funds, and using these funds, these subnational entities are directed to invest in those areas which are actually improving the credit absorption and also improving the livelihoods of the people. Otherwise, if that concessionality is not there, these banks, these subnational entities will never invest in that, because politically it may not be correct for all of them also. They will look at shorter term returns. These are all long gestation, including climate resilient agriculture, rural infra, where roads are not there, then also the accessibility aspects, market development and such other things. So that is one type of financing we do. And then we being a sovereign-backed entity, we are 100% owned by the Government of India. So we have a near sovereign rating. So whatever rating is translating to the cost of funds which we raise, we get very finer spread from the government bonds. It's around 20 bips higher than what government raises. So that is one implied sovereign guarantee which we have. So we are one of the largest issuers of corporate bonds in India. So that too, a public development bank focused on rural development and agricultural development. So that itself tells you about the development of corporate bond market in India. Corporate bond market in India is not that developed. So most of the financing needs or most of the source of funds are from the household savings. And India is having fairly higher level of household savings. Around 32% is the household savings which India has. So most of the development needs are financed from the household savings, plus plus the corporate sector, which from their own internal accruals they reinvest. If you see the stock market or the corporate bond market, India is fairly developed, but the issuers in the corporate bond market are the private sector issuers are very less. So that is one important constraint which we face. So we came out with a novel experiment of sustainability bonds. This was the one of the first kind, that too from a sovereign-backed entity, AAA rated in Indian context. So we went for 50 billion issuance of sustainability bond. But then the problem which we faced was that we didn't get any premium on those. We expected that given the homework which we did for documenting all our activities or proposing which all areas which we need to invest those proceeds, but then we hardly got around 2 bips. Which otherwise we could have raised it from a normal bond issuance process. We were in fact going for a green bond. If you see the asset side of our balance sheet, most of these asset sides will qualify for being classified as green or sustainable, because we deal with poor people, we deal with their livelihoods, we finance rural infrastructure where otherwise without concessionality, private capital will never come. So in that context, we were planning for green bonds, but when we have shelved it, but then we continued with our process of setting our house in order in terms of green taxonomy. So you'll be happy to note that we are the first public development bank in India which came out with a green taxonomy for the agriculture sector. In fact, sector-wise, the green taxonomies for climate resilience and such other aspects, government, this year's budget of Government of India came out with that, and we shared whatever that green taxonomy framework which we developed with the government. Now it is coming out as a national document. Government of India has already issued a green taxonomy for the steel sector. Next in line is the agriculture sector. So now agriculture sector, if you see, it is most affected by the climate events, and also they are also an emitter of greenhouse gases. In India, rice and wheat with flooded irrigation model, which itself is methane emitting models. So we are working with farming communities, giving them grant plus loan assistance. Farming communities, in the sense, we aggregated farmers, because India is highly fragmented because of the pressure of population on the land. Fragmentation is huge. So we need to aggregate these farmers into farmer producer organizations. That was one step which we did. And then worked with those entities to diversify their crop production into climate resilient agriculture. So we developed a lot of pilots, and these pilots were showcased to the subnational governments. And then, because agriculture is a state subject, that is, subnational governments need to deal with strategies and all at the national level. They will give only a broad framework, but then the actual policies need to be developed by the subnational governments. So we work with subnational governments to actually diversify the cropping pattern so that climate resilience is brought in. So now, I saw that this debt, the new instrument which you told, where public debt is being pardoned off in case if those proceeds are being used for sustainability things. But in India, that may not work. In our experience, what we will go for is the sustainability bond or proper bond itself. Where let the market demand market rate interest, we don't mind about that, but then we need to diversify the asset class. The one important experience which we had is that the normal investors in our bond issuances will be mutual funds and pension funds, whereas those entities which are little discerning in terms of sustainability and such other entities came for our sustainable bond issuances as investors. So we could diversify our investor base through the sustainability bond issuance. That is one thing. Even though we didn't get any premium on that, but then the diversification happened. And in fact, we also are leveraging the multilateral development agencies like Green Climate Fund, ADB, and also we are working with European Investment Bank. We are in the preliminary talks with European Investment Bank for raising funds. But then in our case, domestic funds cost itself, when we see the landed cost of a foreign currency denominated bond, if you actually hedge the forex risk, then it will be a little costlier. But then we need technologies, because India is vast. We need technologies to be, the experiences of the developed countries to be supplanted there with some sort of a customization for Indian requirements. And Indian requirements are very huge. It's all 1.4 billion population with a geography very vast, and then almost highest of the gross cropped area if you see, and cropping intensity is very huge. So we need those expertise to come in. But then the funding pattern, we will go for the concessional funds, plus the sustainability bonds which we are issuing, plus the concessional funds from abroad also we'll look at. Thank you.
Thank you, Mr. Shaji, for sharing your insights. That was really, really insightful and helpful to understand practical applications in your own context and to that specific sector. I wonder if I could turn to Jonas to actually reflect on the points you just made, Mr. Shaji, on diversification, but also overall when considering sustainability-linked bonds. How do these instruments fit into the range and the other types of products that are used by development banks?
Yes, thank you, and thanks for sharing your experience. This is very insightful. And I mean, sustainability-linked bonds are part of labeled bonds, right? And have been around for roughly 5 years or so. It's still a relatively new instrument, but with a certain track record. And unlike green bonds or other use of proceeds instruments, the proceeds from SLBs are not earmarked for specific projects. Rather, they are general purpose bonds. And this means that the issuer can use them without specific restrictions, and at the same time has a strong incentive to commit to sustainability targets. And we really see them as complementary to other funding sources. So the benefits for development banks are diversification of funding sources, as you already outlined. I think it's also important to have the flexibility regarding the use of proceeds, particularly for smaller institutions. It's a forward-looking commitment to sustainability targets, and importantly, the potential for a lower coupon if those are achieved. And the Development Bank of Rwanda was the first national development bank to issue an SLB in 2023. This inaugural transaction was very well received by market participants, and they issued a second bond a few months ago. So I think there are signs that there's pickup in interest in solutions like this. And while we illustrate in our work the relevant considerations in the context of bonds, the same principles also apply in the context of loans and could be structured around those.
Thank you, Jonas. And following up with questions to Nicole, perhaps on the debt for nature swaps or debt for climate swaps, are these instruments just do they have more potential? Can we use them more and throughout the ecosystem of PDBs? And do you sense that the demand for such instruments is actually growing? What is the potential there?
I'm going to split a few hairs on this answer, in that the demand is certainly growing, but where debt for nature swaps are most appropriate instrument is actually a very sort of limited number of countries that have the appropriate mix of debt burdens, as well as nature conservation needs, as well as a certain amount of requirement that nature-based tourism or some sort of climate-based desire is involved in the country. So it needs to align with national plans, it needs to align with national economies, and not all countries are really right for it. We think that a little bit that more places are interested in them than are perhaps the right areas for them. And when it comes to public development banks' involvement in that, I think it's really going to have to be a little bit careful on sort of where you get national development banks and regional development banks and subnational development banks to make sure that you're having that additionality and that you're involving the right players without adding that additional complexity to the problem. So certainly when it comes to the idea of dealing with regulations and dealing with a lot of voices in the room, as well as the complexity of these negotiations themselves, you also want to make sure that it's the right type of banks and that they have the right particular needs and capacities as well. So a little bit to make different points there. Thank you.
Wonderful. And Jonas, I wonder if I can call on you once again, because these were instruments that were quite intriguing. And what is the motivation for using that particular solution that you presented rather than others? What are practical considerations for public development banks to use the potential to the full?
Yes, sure. I mean, in our proposal, development banks or development finance institutions can play a dual role, right? On the one hand, as an issuer of SLBs, possibly combined with credit enhancement, and then at the same time, as the provider of such credit enhancement, which is obviously critical, particularly for a lower-rated institution to access the market. I think setting proper targets is a key challenge in the context, and what we see as critical is really to have a material improvement beyond a business as usual trajectory of the issuer, and obviously this has to be consistent with the issuer sustainable development policies in the long run. In this context, I think it's sometimes overlooked benefit is also the increased transparency and data provisioning from issuers around their sustainability trajectory and journey, and we think that's really strong. On the side of MDBs or DFIs that provide the credit enhancement, there are obviously additional considerations compared to a standard SLB through risk assessments, because essentially they have to come up with a probability of the guarantee being called. We shouldn't forget that issuing any bond, and especially as a first-time issuer, is a huge undertaking and also requires additional support in terms of capacity building. But if all these things are aligned, we can see meaningful reductions in cost of capital. In the case studies that we outlined, we have illustrative examples of 70 to 150 basis points, which would be quite meaningful as a step down in the coupon compared, and that is with credit enhancements, compared to standard structures where 25 basis points are more common. So a lot of work, but also a lot of potential for rewards.
Yes, thanks. And so quite significant potential in the reduction of cost of capital, sorry. But if it's done right and within the right context and capabilities, obviously. So I'd like now to turn to Jennifer Zungu from SANBI, the South African National Biodiversity Institute. Jennifer, you bring a different perspective to this debate, as SANBI is a beneficiary of funding from the GEF, the Global Environmental Fund, and from proposed projects through the GCF, the Global Climate Fund. What was your experience working with the public development banks to finance nature conservation in particular? And what financing mechanisms have you encountered to finance conservation efforts where you see the potential coming? Which ones would you recommend exploring, further?
Thanks, Valerie. Yeah, so I am the oddball out. I'm not working in the finance sector. I come from the biodiversity sector. And just wanting to note a little bit that the South African National Biodiversity Institute is an entity of the Department of Forestry, Fisheries and the Environment in South Africa. And SANBI itself is also accredited as a national implementing entity for the Adaptation Fund and more recently became a direct access entity for the Green Climate Fund as well. And so we've been really championing this direct access modality for climate finance, and particularly because of the value that has for local communities. So in terms of our mandate, we really want to champion biodiversity and the benefits that has for all South Africans, and we do that through generating foundational data and knowledge. We build biodiversity knowledge, and we share that in terms of assessments, such as the National Biodiversity Assessment, but also looking at biodiversity science as that underpins policy and then into practice at the end of the day. So how did we get involved with the Public Development Bank, you might ask? It's not the usual type of relationship that you'd find a Biodiversity Institute and a Public Development Bank, such as the Development Bank of Southern Africa, which was a very interesting partnership from the start because we speak two very different languages. They speak finance, we speak biodiversity. And that in and of itself provided a particular challenge for how we needed to work. It meant that we had to actively learn to understand both biodiversity sector but also the finance sector, and also it meant we had to really pay attention. What has been a challenging start at the beginning of this body of work with the Development Bank of Southern Africa has turned into something where we've both learned a lot, but it's also really grown the capacity in both institutions. Many people spoke this morning in the earlier sessions also talking about language, the ability to understand, and that's been a key lesson for us in terms of how we've worked with the Development Bank of Southern Africa as the public development bank that we're making reference to. What has also been really key in that process has been how information that has come through the South African National Biodiversity Institute has really fed into processes within the bank itself. And we see that through the release of the case study on nature data that was released in 2024. That really took information that has come through the work that we've done around ecological infrastructure for water security, through the work around natural capital accounts, but also work that we've initiated with the French Development Agency around nature-related risks and opportunities, to really be able to apply that to the bank and see what does that, how does that show up against their loan book. And it's not just about talking about climate change, it's also talking about climate change and biodiversity. And often biodiversity is the big and hairy, difficult thing, which is a little bit harder for people to get their heads around, but we're at a point now where we have to. Valerie asked earlier around the kind of funding mechanisms used for biodiversity conservation and the kind of role that these public development banks can play in that. Now, historically and traditionally, we would have used grant-based mechanisms. We'd look at philanthropic opportunities, or also looking at corporate and social investments. But the landscape has changed, and so has the kind of pressures on biodiversity, but also the challenges from an economic perspective. As a country, South Africa, we also have to think about what does this mean from a development perspective. And so it makes sense that we work with a development finance institution to sort of answer that question, both even in the biodiversity context. As South Africans, we always hold that lens that when we think about any kind of development, we have to think about how does this address poverty, how does this address inequality, how does this create opportunities and jobs for people. And so even in this kind of relationship, that's the same lens that both the DBSA and ourselves held. And I think that's really important, particularly for emerging economies and for developing economies, to really make sure that that the partnerships hold that. What I want to reflect on in terms of innovative finance mechanisms has been really interesting to listen this morning, not coming from a finance background, but really to listen to the kind of innovation that's being championed, which is really exciting for somebody sitting in the environmental sector. Yesterday I was part of another session where we were discussing biodiversity credits and trying to figure that out. And we're in this particular point in time now where we have to, because geopolitically the landscape is also changing, and that asks that we innovate. I think some of the colleagues also spoke earlier around better coordination. I think that's very key for if we're wanting to do this kind of work, particularly in the transition as we're trying to move closer to get to the kind of targets we've set for ourselves through the Global Biodiversity Framework. But that asks that we build new partnerships and that we play with the unusual suspects. So stepping out of our comfort zone. So that's my challenge and call to action essentially to the partners in the room. Let's play in the unusual spaces. Let's not just play with the people that we normally play with and work with, and let's build new partnerships so that the kind of innovation that we ask for, we're starting to see through those kind of partnerships as well. Thanks.
Thank you, Jennifer. That was really really useful, I think, to bring in this experience working with the Development Bank, especially as you brought in your biodiversity expertise and in a very holistic way went about understanding the development challenges and the way you explored this new relationship with a different partner than your usual partners, with the Development Bank. That took a lot of mutual understanding, I suppose, and many dialogues and exchanges. Thanks a lot. And we're approaching the end of our panel. So I'd like to just say a few words, because this has been a truly insightful conversation, bringing together very different perspectives from research to practitioners on the challenges and opportunities in sustainable investments and the role that public development banks can play, thanks to some instruments that they are offering now and maybe will adopt in the future as they explore further in support of climate and biodiversity and nature. So we heard about the difficulties in measuring, starting from the challenges from collecting the data to measuring what is needed to actually understand the scope of the challenges. It's related to the availability of data, the complex challenge of measuring the performance, but also the effect, the impact of what public development banks are doing. We heard about the importance of standardized, high-quality data to support decision-making while reducing the cost of capital. We heard about affordable long-term capital and how this allows for combining a number of tools in the toolkit and affordable longer-term capital coming from diverse types of instruments, specific instruments that can unlock additional financing opportunities. These tools can be financial and non-financial. We talked about capacity building as being very important when introducing these different tools in the toolkit of public development banks, and while also looking at innovative instruments that PDBs could use to diversify. We heard also again from Jennifer from Sandy that this was the way to go. There's a path forward for innovative solutions there, and being curious about these solutions and testing them out possibly could be a way forward for public development banks. So it might also take different types of approaches, different types of peer exchanges across the banks of the ecosystem to exchange about these tools and new practices, to see investments in climate and nature grow faster over time. And more importantly, this exchange of practices and new approaches in the session points to the need for strong collaboration between the local and the global financial actors, better designed to actually better design financing instruments and continue to innovate while empowering those who have the ear to the ground to bridge these finance gaps. So let's turn all these innovations and ideas into more action and potentially new collaborations. I'd like to extend a huge thanks to all of our panelists and our speakers today for sharing their expertise, and thank you all for participating in this session and engaging with us today in person and online. And let's hear a big round of applause for our panelists and speakers. Thank you.